Almost everyone has borrowed money from banks at some point. In the US, nearly 9 out of 10 adults have some form of debt. From mortgages to student loans to credit cards, borrowing is practically universal. However, even though centralized borrowing and lending in traditional finance has become part of everyday life, it has its issues. For example, it keeps people dependent on operators, it hides its workings behind layers of bureaucracy, and it leaves many locked out of the system entirely. That's where DeFi lending and borrowing innovates. In DeFi, there are no banks setting the rates or controlling the money. More precisely, the rates adjust automatically based on supply and demand, and the liquidity comes directly from people pulled together through smart contracts. There are multiple types of models in the DeFi borrowing and lending space, but there is one that completely dominates the market: the liquidity pool model. Right now, these DeFi protocols hold over $75 billion in liquidity. The decentralized application Aave, which by the way means ghost in Finnish, leads the liquidity pool market. Alone, it accounts for about half of all the money in the DeFi lending pools. Therefore, to better understand this DeFi system of borrowing and lending money, in this video we're going to focus particularly on Aave. What is Aave? Aave is a decentralized finance application that allows people to borrow and lend cryptocurrencies in return for paying and getting fees. Basically, it's a peer-to-peer lending system that uses cryptocurrencies instead of money. Also, Aave uses a sophisticated algorithm that matches borrowers to lenders and establishes lending rates. But how does Aave actually work? Lenders provide liquidity to the protocol's pools. In return, they receive a specific reward. Borrowers are given loans from these liquidity pools through smart contracts, which are computer programs that act as digital agreements. Also, borrowers pay an interest rate for the loans. Most of this tax goes to the lenders, and the other part is siphoned to Aave's treasury to fund development and governance. Besides liquidity pool funding, another innovating part of DeFi borrowing and lending is how loans are secured. In traditional banking, if you want to buy a car, you might put down 20% and use the car itself as collateral. In DeFi, it works differently. You don't just put down a portion, you actually have to deposit more than you borrow as collateral. This overcollateralization keeps the system safe. No bank approvals and no credit checks. Also, there is no fixed deadline for paying the loan back. As long as your collateral stays above the required threshold, you can keep the loan open for as long as you want. But if the value of your collateral drops too much, the system will automatically liquidate it to protect the lenders. To recap, DeFi lending runs on liquidity pools. Lenders earn rewards, borrowers pay interests through smart contracts, and loans are over-collateralized. The key takeaway: no banks, no credit checks, just code and collateral. Now that you know how DeFi lending and borrowing works, check out the next videos in the series to keep building your crypto knowledge.